Right now, silver is trading at levels we haven't seen in over a decade. And if you've been watching the precious metals market, you've probably noticed something interesting. The price action is getting wild. We're seeing massive swings, sudden drops, and rapid recoveries all within the same trading day. But here's what most people don't understand. This volatility isn't random, and it's not manipulation. It's the natural result of how options markets, physical supply chains, and global demand all collide in real time. In this video, I'm going to teach you exactly how silver markets actually work, why prices move the way they do, and most importantly, how to think critically about the information you see online so you can make informed decisions for yourself. Let's start with the basics that most financial content skips over. Silver isn't just a commodity, it's 3 different markets operating simultaneously, and understanding this is crucial. First, there's the physical market where actual metal changes hands. Refineries produce it, manufacturers buy it, investors store it, and dealers trade it. This market moves slowly because metal takes time to move, refine, and deliver. Second, there's the futures market where contracts represent promises to deliver silver at a future date. This market moves fast because it's all electronic and operates with leverage. Third, there's the options market where traders buy and sell the right, but not the obligation, to purchase or sell silver at specific prices. This is where things get mathematically interesting and where most of the volatility originates. Here's why the options market matters so much. When you buy a call option at a $75 strike price, you're buying the right to purchase silver at $75, regardless of where the actual price goes. If silver goes to $80, you can exercise your option, buy at $75, and immediately profit $5 per ounce. The person who sold you that option, usually a large financial institution or market maker, has a problem. They're potentially on the hook for unlimited losses if the price keeps climbing. So what do? They hedge their exposure using something called delta hedging. Delta is the rate of change between the option price and the underlying asset price. Think of it like this. When silver is trading at $50 and someone buys a $75 call option, that option is so far out of the money that it has almost zero chance of being exercised. The delta might be 0.5, meaning the option seller only needs to hedge 5% of the potential exposure. But as the price of silver climbs towards $75, something fascinating happens. The delta increases exponentially. At $70, the delta might be 3. At 73, it jumps to 6. This is where the volatility comes from. It's not a conspiracy, it's pure mathematics. When silver approaches key strike prices where large numbers of options are concentrated, the hedging requirements create a feedback loop. Market makers need to buy to hedge, which pushes the price higher, which increases the delta on even more options, which requires even more buying. On the flip side, if the price drops away from those strike levels, market makers can sell their hedges, which pushes the price lower, which decreases deltas, which triggers more selling. These are called gamma squeezes on the upside, and delta unwinds on the downside. And they're a normal feature of any options market, not just silver. Now, let's talk about why silver specifically sees such dramatic price action compared to other commodities. Silver has a unique characteristic. It's both an industrial metal and a monetary metal. About half of all silver demand comes from industrial applications. Solar panels, electronics, medical devices, and batteries all require silver because of its superior electrical and thermal conductivity. The other half of demand comes from investment and jewelry. This dual nature creates tension. When the economy is booming, industrial demand surges and prices rise. When economic uncertainty hits, investment demand increases as people seek safe haven assets. Sometimes both happen at once, creating extreme demand pressure. On the supply side, silver faces real structural challenges that have nothing to do with market manipulation. About 70% of silver is produced as a byproduct of mining other metals like copper, lead, and zinc. This means silver production doesn't respond quickly to price signals. If the price of silver doubles, mining companies can't just produce more silver because they're primarily mining for other metals. The silver comes along for the ride. This creates what economists call inelastic supply. When demand spikes, supply can't keep up, and prices can move dramatically. Let's address something you need to understand about market commentary online. There's an entire ecosystem of content creators, newsletters, and social media accounts that profit from telling you precious metals. Markets are rigged. They make money from affiliate links to dealers, from selling premium subscriptions, or from advertising revenue generated by shocking claims. I'm going to teach you how to spot this content so you can avoid being misled. First, watch for claims of secret insider information. If someone tells you they have a source who was in a private meeting with executives from major banks, and they're sharing this information with you for free on YouTube, ask yourself why. Real insider information is illegal to trade on, and people who actually have it do not broadcast it online. They either use it quietly or they report it to regulators. Second, be suspicious of claims that name specific people or institutions. Coordinating illegal activity without providing verifiable evidence. Market manipulation is a serious federal crime. If someone had real evidence that JP Morgan, HSBC, or any major bank was coordinating to fix prices, they wouldn't post it on social media. They'd take it to the SEC, the CFTC, or the Department of Justice and collect a massive whistleblower reward. The fact that these claims circulate online for years without any regulatory action should tell you something about their credibility. Third, watch out for content that uses precise numbers and specific details to create false credibility. Scammers know that saying there are exactly 41,000 contracts at the 75 strike sounds more believable than saying there are a lot of contracts, but you can verify open interest data yourself. Go to the CME Group website, look at the actual options chain, check the numbers. You'll often find the claims don't match reality or the numbers are taken out of context to sound more dramatic than they are. If you're still watching, you're clearly serious about understanding markets rather than just consuming entertainment disguised as financial advice. And I want to make sure you have access to the best educational resources. I put together links in the description to free courses on options trading, commodity markets, and technical analysis from reputable sources like the CME Institute and the Options Industry Council. These are the same materials professional traders use to learn, and they're completely free. Check them out after this video. Now, before we go further, here's something important you need to hear. This video is for educational purposes only. Nothing I say should be considered financial advice, investment recommendations, or a suggestion to buy or sell any security or commodity. I'm not a licensed financial advisor, and you should always consult with qualified professionals before making investment decisions. Markets carry risk, and you can lose money. Do your own research, understand your risk tolerance, and never invest more than you can afford to lose. Let's get back to understanding how silver markets actually work in practice. One of the most misunderstood concepts is the relationship between paper markets and physical markets. You'll often hear claims that paper markets suppress physical prices or that the paper market is disconnected from reality. This fundamentally misunderstands how these markets function. The futures market exists to provide price discovery and risk management. A solar panel manufacturer who needs 1 million ounces of silver delivered in 6 months does not want to gamble on where prices will be. They use the futures market to lock in a price today, guaranteeing their costs and allowing them to plan their business. That's a legitimate economic function, not manipulation. Similarly, mining companies use futures markets to hedge their production. If you're a silver mining company that will produce 5 million ounces over the next year, you might sell futures contracts today to guarantee a minimum price for your output. This protects you from price crashes, but also means you don't capture the full upside if prices spike. Again, this is risk management, not suppression. The paper market and physical market are connected through arbitrage. If futures prices diverge too far from physical prices, arbitrageurs step in. If futures are trading at $80, but you can buy physical for $75, you buy physical, sell futures, wait for delivery, and pocket the difference. This arbitrage mechanism keeps the markets aligned, though it's not instantaneous and there can be temporary dislocations. Speaking of physical markets, let's talk about what's actually happening with silver supply and demand right now. According to the Silver Institute, which compiles data from across the industry, global silver demand has been increasing steadily. In recent years, we've seen deficits where demand exceeded new supply. However, and this is crucial, these deficits are filled by above-ground stocks. There are billions of ounces of silver in existence in various forms: jewelry, coins, bars, industrial products, and stockpiles. When there's a supply deficit, prices rise, which incentivizes recycling and selling from these existing stocks. This is how commodity markets balance. The idea that there's a massive shortage that will cause an imminent price explosion has been circulating in precious metals communities for decades. I remember reading the same claims in 2011 when silver hit 49. The thesis was that silver would go to $100, then $200, then $500 because of industrial demand and investment demand colliding. What actually happened? Silver crashed to $14 over the next few years. I'm not saying silver can't go higher. It certainly can, and there are legitimate bullish arguments. But be very careful about claims that frame any investment as a sure thing or a guaranteed moonshot. Let's talk about what actually drives sustained moves in commodity prices. It's not secret meetings or coordinated manipulation. It's the slow, boring accumulation of supply and demand fundamentals over time. Silver had a massive bull run from 2001 to 2011, going from $4 to $49. Why? Multiple factors. China and India experienced explosive economic growth, driving industrial demand. The financial crisis created massive monetary stimulus, increasing investment demand. New supply from mines couldn't keep pace. These are the real factors that drive decade-long trends. When you're evaluating whether to invest in silver or any commodity, you need to ask yourself fundamental questions. What's the supply outlook over the next 5 to 10 years? Are new mines coming online? Is recycling increasing? On the demand side, what industries are growing that consume silver? Is electric vehicle adoption accelerating solar panel installations? Are new technologies being developed that require silver? These are the questions that matter, not whether some trader on Twitter claims they have secret information. Here's something else you need to understand about commodity markets. Volatility itself creates opportunity for those who understand it and risk for those who don't. Professional traders love volatility because it creates mispricings they can exploit. If you're a long-term physical holder, volatility doesn't matter much. You're holding for years or decades as insurance or diversification. But if you're trading on short-term price moves, volatility can wipe you out through stop losses, margin calls, or simply buying high and selling low out of fear. Know which type of market participant you are before you commit capital.